Hey, Dan Passarelli here. How are you feeling today? I would like to know if you would. I'm looking at my questions box right now. Give me a big old woo-hoo if you're here and you're ready to go and you can hear me. I need to know if you can hear me. I need to know if you can find the questions box and find it, type questions in, and be able to participate today and get the most out of this as possible. Can you hear me? Yeah. All right, Stephanie. Thank you. Thank you very, very much. I love that. All right, today we're going to be talking about selling puts to generate income. Now, before we get started, I need to point out options are not for everyone. You should read the characteristics and risks of standardized options for trading, and you can get a copy of that by emailing investor services at theocc.com. All right, allow myself to introduce myself. In case you haven't heard, I'm Dan Passarelli, and I am an author. I'm an author of two books on option trading, and I've been a part of a couple more books on option trading. And I am a trader myself. I traded down on the floor of the Chicago Board Options Exchange for many, many years. And then I started working for the Chicago Board Options Exchange as an employee. They flew me around the world teaching people just like you how to become better traders, which was quite an honor. And I still trade to this day. Been there, done that, still doing it. And most importantly to me, I am the founder and still CEO and president of Market Taker Mentoring, which is the global leader in option trader education. And I'm a trading industry collaborator. I get to collaborate with really great organizations like Firstrade. I've collaborated with every options exchange in the world, quite literally. And I'm quoted in the financial media. I get to be on TV a lot. I am a family man. I have my wife, Kathleen, who some of you are familiar with, who are already part of the Market Taker family, as well as my two adult children, Sam and Isabel. And besides trading, which I find very fun, I like to do other fun stuff. I am a runner. I enjoy food and wine. People call me a foodie. I'm a traveler, been in a lot of countries all over the world together with my family and as well as where my career as a trainer takes me, and a musician. I enjoy listening to music, playing it, and find that all really, really fun too. Now, that's enough about me. Let's talk about the important person here, you. I want to give you a gift, and it doesn't cost you anything. If you go to markettaker.com, markettaker.com, and I'm going to type this answer here, markettaker.com, and I'm just going to send that answering William's question. Click that, and then just go up to the top right and click join free. And we've got a lot of different classes there that are going to help you with put selling and everything else that we are going to talk about for the rest of the day. So please, that is my free gift to you. William, the book that I wrote that is on the Greeks is called Trading Option Greeks, Trading Option, singular, Greeks. And just get it on Amazon or wherever you get your favorite bookstore. Okay, so that's enough here today about the introduction. Let's get into the meat and potatoes of this thing here, shall we? So we are going to talk about selling puts today. So selling puts is a very, very simple, typically investor-oriented strategy, which can be risky, can be conservative. And I want to back up for a second too. When I say selling a put, I don't mean, I buy puts and then later I sell them to try and take a profit. I mean, I don't have a position and I sell a put, which is shorting a put. So that is going to be our topic of conversation today. Now, why would I do something like this? Well, because it can be a great way to generate income on low volatility stocks or ETFs. I can potentially buy a stock at a lower price than the current market price. Sometimes, even if it doesn't go down. So there's a lot of interesting things here to talk about. I'm going to cover the basics here. And, like I said, if you do go to markettaker.com/join free, you can join our chat room. If you find follow-up questions, if you have follow-up questions, you can definitely DM me there. But I'll take questions at the end of this discussion as well. So what is the risk reward if I were to short a put? There's Firstrade put something in the chat, an important message. So make sure that you're getting that. So when I sell a put, I can make whatever it is I collect for that put. It's kind of like almost like getting my profit up front, but it may or may not remain a profit. I get this cash up front, and that is my maximum profit potential. And if all goes well and I did a good job and variance was on my side, then great. I end up with that as my complete profit. If the trade goes against me, now there's potentially substantial risk, but I want to frame that in two different ways in this workshop today. So before I do that, let's just go with just what a regular old put is. Well, okay. Say I sell one November 60 put at $2.75 on whatever stock, whatever price it's trading, whatever industry it's in. This is just to get you to see how this whole thing works. Okay. Well, if the stock is above the strike price at expiration, and to be fair, a lot of the times that's what we're doing. The stock is above the strike price already, so it would have to go down to not reach my maximum profit. If it is at or above $60 a share at expiration, I would make my maximum profit of $2.75, which is incidentally what I collected when I sold this put short. Everybody on the same page so far? Give me a big old yes if you are on the same page with me. We're simpatico so far, a mind meld, if you will. Give me a big old yes. Throw in an exclamation point if you're feeling crazy. Use all caps. I won't think you're yelling at me. I'll think you're having fun. Yeah? We're all on the same page. We get it. This is the easy part. Yes, yes. Hit that Q&A box. 1, 2, 3, go. There we go. We got some raised hands. I'll take a raised hand. Thank you, George. Thank you. Who is that? Somebody else? One other raised hand. Okay, good. Kevin. All right. You guys are awesome. I love it. I love it. I just gosh darn love it. Okay. So easy enough. Well, what happens if the stock goes down and is trading below $60 a share at expiration? Well, that may or may not be okay. If it goes just a little bit below 60, I might actually still have a profit. Because here's what happens. If at the expiration of this put, which in this case would be the third Friday of November, I'm still holding the put, the stock is below 60, the end of the day bell rings, what happens? Well, I would get what is called assigned, and I would buy 100 shares of the stock at 60 bucks. Why? Because I sold this put short, but I sold it to someone else who was the buyer in this two-part transaction. That's why they call it a contract, right? So the person who owns the right to sell the stock to me at 60, if it's trading below 60, well, that's a pretty good right to have, right? You can sell it at a higher price than where it's trading. So I'm going to get assigned and I'm going to buy the stock from a person who assigned it or who exercised it. Okay, so that might be okay. I mean, what if the stock is trading at $59.90? Well, I might still have a profit, wouldn't I? Because if you think about it, yes, I'm buying the stock at 60, but I also collected $2.75. So my break even, which is really effectively the price that I would buy the stock at. If you think about, I'm actually buying it at 60, but I get to keep $2.75. So my effective purchase price, or my break even, is $57.25. It's just the break even is the put strike minus the put premium. Very easy to remember. Write that down. Hope you're taking notes. Write it down. All right. So if we're above 57.25, we got a winner on our hands. If it's below 57.25, well, then we got a loser on our hands. But could that be okay? Sometimes it could. Let's explore that. So there's two different ways of doing this here. Two different methodologies. There's what we call naked puts and what we call cash secured puts. All right. Let's first talk about naked puts. So naked puts is simply selling short a put. It is a low reward, high risk strategy. Now, that probably doesn't resonate with a lot of people. And in fact, the naked put, doesn't really resonate with me. The objective here, like the objective of selling puts, is what I like to call, there's one of two objectives. You want to either skate or trade. That's not on the screen anywhere, so write that down. Skate or trade. When we're selling naked puts, we typically want to skate. We typically say, okay, the stock is here at 100 or whatever. I'm going to sell the put at 90 because there's support. I don't think the stock is getting down to 90. When the option expires, I'm just going to keep that premium. I'm going to get that maximum reward. Okay, that's called wanting to skate on the put. But to me, I am not a big fan of substantial risk. I don't like low reward with high risk. I like to balance that out. Do you like to balance that out? Give me a big old yes. Hit that questions box. Give me a big old yes if you kind of prefer to balance out the risk a little bit, not have low reward, high risk, right? Give me a yes. Give me a yes. While you're typing, while you're finding that question, folks, I know you know where it is. Thank you, Kevin. Thank you for the all caps and exclamation point. I don't think you're yelling at me. Usually if I get an email in all caps, I'm like, geez, this person's really mad, but I think you're just excited and I like it. Okay, so look, for me, in lieu of selling naked puts when I'm trying to skate, because I don't think it's going to get down to that point, what I'll do is I'll sell a put credit spread. Now, there's good news and bad news. What do you want first, the good news or the bad news? Well, I'm going to give you the bad news first. The bad news is I'm not going to talk about put credit spreads today. I'm just going to talk about selling puts. But the good news is, guess what? Next week, I'm looking at my schedule. I got a thumbtack to my wall over here. Next week, we're talking about selling credit put spreads and call spreads for that matter. So you kind of get a twofer, which is awesome, isn't it? Okay. So very aggressive investors, they might consider naked puts, and there's nothing wrong with that. So let's say we're looking at a chart of, say, Tesla. We're looking at a chart of Tesla, and we notice that, oh, look, a couple days ago, it bounced off pretty solid support here at about $185 a share. There's more support down lower, but this is a support level. And it looks like it's consolidating. There's a gap to fill. And I think, hey, you know what? I don't think Tesla's going to go down any further. I think it's probably going to go up. It might stay where it is. It might go down a little bit. But if it does, I think support at 185 is going to hold. Okay? This is hypothetical, right? I'm not saying this is my favorite trade ever. I'm just giving it an example. All right, so let's jump into the option trade chain here at Firstrade. And we're going to see there's all these different expirations. There's all these different strike prices. We got to pick the one that's best. Well, I'm going to give you some rules, and I need you to write this down too, because this is not necessarily shown on any slides either. We want to keep our short puts less than 6 weeks. Now, for me, I typically keep them less than 3 weeks. So if you have a stock like Tesla that has weeklies, I've only got like 3 expirations to choose from. When I took this screenshot yesterday, there's one that expired in 3 days. 3 days? Yeah, well, 3 days. Oh, there's one that expired in 3 days, one that expired in 10 days, one that expires in 17 days. So the 3-day one, usually that's too short to coincide with the strike price, which I'll talk about in a second. And I like to keep them as short as possible because of something called theta, which we talked about last week. I hope you showed up to my webinar last week with Firstrade, where I talked all about the Greeks. If you didn't, go back and check out the archives, because it's there and there's important stuff there. But basically, I'm going to give you the gist of it. If I sell a 1-week option, well, no, let me back up. If I sell a 4-week option, I might get like $2 or something in hypothetical stock, hypothetical strike. But if I sell a 1-week option, I might get like 75 cents. So if I sell a 1-week option 4 weeks in a row, which is kind of like selling a 4-week option, I'm just selling them incrementally, 1 week, 1 week, 1 week, 1 week. If I can sell them each at 75 cents, I'm going to get $75, $1.50, $2.25, $3. So this is one of these things, I guess we can call it synergy, where like 1 + 1 + 1 + 1 is more than 4. So I like to keep them as short as possible, but sometimes if it goes too short, you can't get it. So what I like to do is I like to look at a few different expirations, a few different strike prices, and pick the best one. Now, here's how you're going to pick the best strike. Remember I showed you, oh yeah, there's resistance at $185 a share. What does that mean? Well, that means that like it used to have a hard, well, here it kind of had a hard time getting below resistance, dipped below it, but then, you know, traded above it until it finally broke through, and then it had a hard time getting above it. And then once it did, it bounced off it again here. This is this point where there's like a lot of buy and sell orders. In this case, now there's a lot of buy orders because we're above there. And so if there are a lot of buy orders and we've seen it bounce off that area and go back higher and have a hard time getting below it, well, guess what? Wouldn't that be a great strike to sell if I'm trying to skate? If I think that Tesla will have a hard time getting below 185 because there's support there, well, what if I sold the 185 puts? Well, if my goal is for them to expire and I get to keep the premium that I sold it at, that's a pretty good strategy, isn't it? So write this down. We always want to sell puts at or below support when we're trying to skate. All right. So next up here is let's take a look at what this would look like if I sold this 10-day put and held it all the way until expiration. Okay, well, look, same sort of diagram here. I sell one Tesla, August 23rd, 185 put at $2.75, 10-day till expiration in this hypothetical example. And the stock was at, let's go back here for a second. The stock was at $197.50. So that's like here. I've already got this big, huge head start on being right. In fact, if we go back to the chart, the stock was at 197.50 at the time, which is like up here. If it goes up, I win. If it stays the same, I win. If it goes down a little bit, I win. Okay, pretty good situation to be in so far here, right? So if it is still above 185 at expiration, and I hold it all the way till expiration and it expires, the put disappears, it's taken off my sheets, and I get to keep that $2.70 option premium, and that represents my maximum profit. Now, there's a couple things we got to talk about here before we go any further at all. One is $2.70. How much is that? Well, each option represents the rights on 100 shares, right? So $2.70 a share times 100 shares, that's $270 of money. That's for a one contract trade, sold one put. If I sold 10 puts, that would be $2,700. We can scale this as big as we want, right? Okay, now another thing. I will tell you right now, this webinar is intended to teach you how to sell puts, how this thing works. And that's why I use these P&L diagrams. It's a very simple sort of textbook explanation. What I like to do in practice is I like to buy the put back before it expires. Now, I like to give it a lot of leeway. I sell cash secured puts, which we're going to talk about next, in my IRA every single darn day. I was just doing that this morning. Did I end up getting filled on one this morning? I forget. Covered calls and cash secured puts. As soon as I sell a put, you know what the first thing I do is? I bet somebody knows. What do you think is the first thing I do as soon as I see the fill pop up on my phone? You know what I do? I immediately put in a good till cancel limit order at somewhere between 3 cents and a dime. If it's really liquid and I sold it at over $1, I'll put in a 4-cent bid. If it's markets are a little bit wider, I'll put in a 5 or a 10-cent bid. Why do I do that? Because sometimes, hey, everything's going great. The stock's still up around 197.50. Oh, it comes down around 190. Oh, I still have plenty of wiggle room. Expiration's in 3 days, and then boom, it gaps down and I run into trouble. So if I can take a profit early, I will, and then just move on to the next trade. Okay, so what if the stock ends up falling and it's down below 185 at expiration? Well, what the heck happens then? Well, we went through an example of that, right? If it falls a little bit, that's okay. It's actually got $2.70 wiggle room to fall. Because if we were to leave it on until expiration and accept assignment, which with a naked put we wouldn't want to do, because we might not have enough cash to buy 100 shares at $185. That's $18,500 of cash I need. I might not have that cash. So I probably don't want to get assigned. I probably want to skate. So I would definitely take this off by expiration. But if I did leave it on, I would get assigned, buy the stock at $185, plus consider the $2.70 that I collected when I sold it. So my break even here, of course, is $182.30. If I'm down below that, I'm probably going to want to buy that put back, take a loss so I don't get assigned, and move on to the next trade. All right, so I got a couple of thoughts. I always got a couple of thoughts. I'm crazy like that, but here's my thoughts. These trades can be good in markets like the one that I showed you here, this one, where there was this precipitous drop, because you know what happens? For those of you who attended the Greeks webinar last week? Yeah, last week, I talked about implied volatility and Vega, right? What happens is those options tend to get a lot more expensive. So I can sell them when they're overpriced. They're overpriced because the stock's down, and puts get more expensive when the stock's down because of what? Delta. But they also get more expensive because implied volatility goes up. There's more demand for people to buy those puts, but the brave, the fearless like us, we are on the other side of that. When people are buying overpriced insurance, we're in the business of selling it to them, right? I like selling things when they're overpriced. But this is a pretty aggressive trade. There's limited reward. So what I would typically do is instead of just selling the 185 puts naked, not having cash in my account, hoping I skate, I would protect myself. Buy the 185 puts and sell the 182.5 puts, which is a put credit spread, which we'll talk more about next week. All right. At expiration, if I did hold it all the way till expiration, if the put expires, I keep the premium, right? Which could be good. I mean, it is good. If my goal is to skate, it is good. If the put is in the money, I acquire the long stock effectively at the strike price minus the premium, which if I have the cash in my account, might be okay. I can just roll that into the wheel strategy and sell a call against it. We'll talk about that in an upcoming future webinar. But if the stock falls really sharply, I can really run into some trouble. Okay, let's talk about cash secured puts. Cash secured puts is like mechanically, it's the exact same darn thing. A cash secured put is just selling a put, but with a plan. And part of my plan is, in this case, I often actually want to get assigned. Yes, you heard me correctly. I'm not crazy. I'm a little crazy, but I'm not that crazy. This is not a crazy thing. Most of the time when I sell puts, I literally want to get assigned. Right? Isn't that crazy? It's kind of crazy. But that is my plan. And so what I do is I do it in a cash secured basis. Now, what does that mean? Cash secured? What does that mean? It means that I hold cash in my account to potentially secure finance the purchase of the stock if I get assigned. I got the money right there, and I hope I get assigned. If I do, I'm going to buy the stock because I want it for the long run. Now, this is an investor-oriented strategy. Zoya says, do you pay attention to IVM probability? Implied volatility move, is that what you're talking about? I wrote in the, what does the V stand for? IVM. Oh, maybe it's a typo. Where's the V on the thing? You mean the probability of it being in the money by looking at the delta? Is that what you're talking about? All right. Well, I'm not going to pause and wait. I'll answer that as yes. Okay. Yes and no. Delta, like, so those of you who attended our webinar yesterday, no, last week on the Greeks, I said delta is a loose rule of thumb for the probability of an option expiring in the money. Now, you'll see that in books. You'll see that in webinars. But if you read like the fine print, if it's a well-written book by somebody who actually knows what they're talking about and understands how the Greeks work, there's always going to be a little footnote or something in parentheses that says this is not mathematically accurate. So using delta as a probability of an option expiring in the money is a nice little rule of thumb, but it's not really mathematically accurate. So I look at it, but I take it with a grain of salt. Okay. Motivations. Why would I sell a cash secured put? Well, to generate income on low volatility stocks or ETFs, and to potentially buy a stock at a lower price than the current market price. And I have enough capital to do so if I do indeed get assigned. All right, so the risk reward. There's limited profit potential, potentially substantial risk, and there's the I don't know if I want to call it, this is kind of risk and reward. There's the possibility of getting assigned. So let's look at this. So let's take a stock that is maybe a little less volatile. I don't want to get into opinions about, different stocks or such, but I think a lot of investors would agree that Apple is maybe a higher quality stock, like in terms of blue chip. We used to call them blue chips. Your grandfather used to call them blue chips. Like, Apple definitely moves around a bit, as you can see, but is maybe not quite as wild as Tesla, right? And, we could debate the fundamentals of Apple for a while too, but they ain't going out of business anytime soon either, I don't think, right? So it could be reasonable to hold Apple for the long term. And wouldn't you know it, we got a little bit of a dip here. It went from 237, got down to about 196. It's a lot, it's like 20%. And now, it's showing good signs of heading back higher, filling this gap that was established here. So, maybe I look at this and say, okay, shoo, we're going to be out of the woods. And again, this is just a hypothetical example, right? We do trade ideas in other classes at Market Taker anyway. This is just to teach you how this works, so you understand it. So as an example, maybe I think, hey, we're out of the woods. Apple's going to be strong again. This looks like a good place to get in and buy it on this dip. Okay, so with Apple at $217.50, if my objective is to get assigned so that I do end up buying that stock, I probably want to do it at a price where that becomes a little bit more likely. Now, if I look at this chart, yeah, man, it really dipped way down to here to about 196, but a very strong comeback. If I'm thinking, yeah, it's probably not getting back down below 200 again, I think it's probably just going to go up from here. Might have a little bit of a dip, but we're strong. If that's what I'm thinking, I'm going to want to sell a strike closer to the money than I did with Tesla. I'm not going to get super hung up on support levels. I might sell something like the 215 strike. And that's about right. That's pretty typical for what I do a lot of the time. I'll sell something closer to the money where it doesn't have to go down too far to be in the money at expiration. Sometimes I'll even sell right at the money, 217 and a half. I've been known to even sell slightly in the money if there's enough time premium left in it. But I'd say more often than not, this is about something that I would do. Sell the 215 puts. I could sell those for $2.70 in this example. So how does that work? Well, remember, Apple was at 217.50. So not like the Tesla example where it's, way up here. It's close. It's about right here. So if it stays above 215, well, okay, I make my 270. I'm just talking about, this is also a 10-day option example. I mean, hey, man, if the stock is 217 and I make 270 over 10 days, that's about what, 12% in 10 days? There's 36 point something 10-day periods in a year. That's okay, even if I missed it. But what if Apple is below 215 at expiration? Oh no, I could lose money. I mean, yes, my break even is 212.30, but oh no, I could lose money, right? Well, yeah, but I don't really think about it that way. If I like a stock, its fundamentals, its technicals, and I buy it for the buy and hold strategy, throw it in my IRA and figure I'm going to keep it for the next 10 years, I don't really sweat it if I lose $3 on the stock, the next week. Doesn't matter. What's good here is like what a real sweet spot is like, let's say it's trading at 215 after expiration. you purposely allow yourself to get assigned, your effective purchase price is $212.30, not $214. Interesting, right? I mean, heck, even if it's down at like 210 and my effective purchase price is $212.30, I mean, how many times have you put in a limit order like, oh yeah, Apple's trading at $217.50? Well, I'll put in a limit order to buy it at 217. Maybe it'll dip and I'll, get it a little bit cheaper than here. You're basically doing the same thing. So even if it does go down from this agreed upon quote unquote limit order, I'm happy about it, right? So here's some thoughts. My motivation really needs to be more than simply generating income. Where with the naked put, my plan is usually to skate and not get assigned. With the cash secure put, my plan is to trade into the stock, to buy the stock. So the $2.70 limit profit potential is small compared to how close to the money it is relative to the Tesla trade, a lot further from the money and still getting, it was coincidence, that was 270 also. So I'm like actually hoping to get assigned and buy the stock at the effective price of $212.30. I have the cash in my account to secure that stock purchase. So like I said, this trade basically functions like a limit order to buy the stock. All right, now I want to talk about functionality and management. Before I do, does anyone have any questions? Do you have a question so far? I know there's a little bit of a delay, and I think I see that some people are on YouTube. And the YouTube questions, I don't know if they pop in or not. I did give you that resource earlier where you can DM me in our chat room, or maybe some of the good folks here at Firstrade will pop your question in there. But either way, if it takes a while to get your question in there because you're on YouTube or something, don't worry about it. Save that question, because at the very end of this, I'm going to have a Q&A period. So let's get on with it. Now, a couple of weeks ago, oh, wait, there's a question. Never mind the man behind the curtain. Lee Jin says, do we plan, or Jin Tang, I think, right? Do we plan to buy back the naked put if we meet a certain percentage of profit? Yes, but for me, that percentage, well, with the cash secured put, I'm still going to, okay, with the cash secured put, I'm still going to put in that limit order, because if the stock is, not cooperating and going down through my strike, if it's staying up or if it goes up a little bit, I'm going to want to buy back the cash secured put early and maybe roll it into selling another put with more time to expiration. So I take in more premium or even a higher strike to make it more likely I get assigned. And then the way my brain thinks about it is I collected that first premium on the first put I sold, bought that back at like 4 cents. So, okay, there's $260 or whatever in my account. And I sell another one, even if it's at a higher strike, maybe I sell that for $2. Now I've got $4.60 or whatever in my account. Even if I'm selling a higher strike, I've got 2 premiums collected. So and I know your question was about the naked put. That's how I do with the cash secured put. With the naked put, yeah, I probably want to be a little bit more aggressive. The cash secured put, yeah, like I'm trying to get about 95% profit. With the naked put, I might take I still want to be kind of greedy with it. As long as the trade is working out and not going against me, trending down towards my strike price, I'm going to let it ride for as long as I can. I might buy back half of the position at, say, like a 75% profit or something, and then let the rest of it ride just to take some risk off the table. Yeah. Okay. And can you share more about the limit order later when we have time? Yes. In fact, what I usually do is when somebody asks a question, I delete it just to clear my screen. I'm going to leave that one up there to make sure I answer it. Okay. Now let's see here. 2 weeks ago, those of you who watched my webinar 2 weeks ago, it was on collars. If you didn't watch that webinar, go back in the archives on Firstrade website somewhere and make sure you watch that, because that was a really useful one, especially if you have any jitters in the market right now. Right now is kind of a good time to use collars. So a cash secured put and a covered call are related. In fact, they are synthetically equivalent. What that means is if I'm looking at Apple and I'm looking at the let's go back. I'm looking at the 217.5 strike, let's say, right at the money. I could sell that put, and that would give me a profit and loss diagram, kind of like this one, but the numbers would be different. Or you know what I could do? I could buy the stock and sell the call, and that would give me, synthetically speaking, the same risk reward. As long as it's on the same stock, in the same expiration, and with the same strike price, they are synthetically equivalent. Now, there are some differences there. One difference is there's an interest rate component. If I own the stock right now, there's an opportunity cost. And I talked about this last week as well, and maybe the week before too. If I buy the stock now, I own the stock. I own this asset. Could go up, could go down, could get a dividend, could not get a dividend. But if instead I don't buy that and I put my money in a CD or a treasury bill or something, some bank accounts, that high yield savings account, I might earn 5% on that money. So there's an opportunity cost to buying the stock. And so that's why there's a little bit of a difference between the covered call and the cash secured put from a math standpoint, but the math actually kind of ties it together. Because if I just sell the put instead of buy the stock and sell the call, I've actually got that capital. I could invest it. In fact, I could take that and maybe I could earn 5% on it. Now, if I get assigned, then okay, I get assigned and now the capital is put into the stock, which, again, might be my objective anyway. So this is something to know. Synthetics is an important thing. One of the things I do talk about in my book and talk about in some of my other webinars that I do directly with Market Taker. Let's analyze this cash secured put deal here. So technically, I might look for support to find stocks that I think are strong candidates. I might not necessarily sell the put at support like I do with the naked put, but like I'm looking for a technically strong stock. I prefer lower volatility because I want a high quality stock. As far as volatility goes, implied volatility should be elevated, should be in the top half of the recent range. Now, if you don't have a solid tool for analyzing implied volatility, that's fine. It doesn't matter. As long as you're getting a big enough premium that you feel good that if you get assigned, it's enough premium to give you extra wiggle room, that's great. Fundamentally, I want to avoid earnings or other expected volatility events like for those of you who are watching this live, what is today? August 13th of 2024. Right now, I would say the biggest data point of the month is the monthly unemployment figure that come out. because that's what the Fed is watching at this point in time, even more closely than inflation, I would say. So I want to avoid those things because those are days where there could be really big volatility up or down. So also fundamentally, I want a good solid stock. If I am good with reading financial statements, I'll do that. Most options traders are not. Most mere mortals are not. So, you know, I'm going to do my research in whatever way I do my research to find quality stocks. Okay, cash secured put management. If the stock is trending lower, I'm pretty likely to let assignment occur. If the stock moves violently lower, I might close the trade, possibly take a small loss now. I might use a stop loss on this. I don't use stop losses with spreads, but I do with single leg options. Okay, next, if I get assigned, great. I might have achieved my objective if the objective was to get assigned. Now I have the buy and hold strategy. I might set a target for a stop loss. Maybe I'll set a, GTC for a profit taking order, probably significantly higher if it is now a buy and hold trade, or I can roll it into an out of the money covered calls, establishing a covered call, which is when I sell puts and then sell calls and vice versa. We call that the wheel. And I promise you at some point in the future, I will do a webinar here with Firstrade on the wheel. So to wrap up, before our Q&A here, we're going to go into Q&A in a second. I've already got one question in here. If you have questions, now's time to put it in, but let me finish up with this part. Short puts, like all option strategies, they have a specific purpose. It doesn't do everything. Not all my trades are selling puts, that's for sure, but I do a lot of them because they're very, very useful and very, very versatile. If, I'm selling it because I want to skate, I'll probably do something different, a quick credit spread like we're going to talk about next week. I always want to select a strategy that fits the market, whatever that might be. Okay. So, Jin Teng, can you share more about the limit order later when we have time? Yes. So I referred to this as and like you have to be watching the video because I'm making air quotes, a limit order, because it's not technically a limit order, but it kind of functions like a limit order. If Apple is at 217.50, like how many times have you ever, and I'm talking not just to Jintang, but to whoever's listening, and you don't have to answer, you can, but you don't have to answer. How many times have you ever said, oh, this stock is at 217.5. I'm going to put in a limit order to buy it a little bit lower. Maybe that's 217. Maybe that's 215. You put it in as a GTC, right? How many times have you ever done that? You've done that. If you've been trading and or investing for a while, you have done that. If you're new to it, you haven't done it yet, but you will. Okay, well, this is like that. Because if it was a limit order, I would only get filled if it's a $215 limit order. I'm only going to get filled if it gets down to $215. Selling a cash secured put is like that because if it gets down below $215 and still is below at expiration, I will get assigned and I will buy the stock at $215. Now, there's a couple notable differences here. Some good and some not necessarily bad, but just different. The good thing is I'm actually getting paid to work this limit order. If I sell these puts at $2.70, I'm getting $270 put in my account to work this limit order. Wowsies, right? But the thing that's different, not bad, but different, is that with a limit order, if it goes down to or below 215, I get filled in my limit order. With the cash secured put, it could go down below 215 today, but back up above it tomorrow, and I don't get filled on it. So the timing ends up being a little bit different. All right, very good question, Chintai. Shichang, or Shichang, I believe I pronounced that okay, right? I learned a little bit of Mandarin back in my day, but I forgot most of it. I'm assuming it's Chinese. How to select the days to expiration, 30 days to 60 days or 1 week. Yeah, so I talked a little bit about this. Always stay below 6 weeks, okay? Because if it's close to the money, the less time you sell, the better. Like I would rather sell 4 1-week options than 1 4-week option, because I'll make more if I sell 4 1-week options. Plus, I get to change the strike once a week as well. If it stock's a little higher, I'll sell a higher strike. If it stock's a little lower, I'll sell a lower strike. So always below 6 weeks and lean towards the shorter time frame. But now, you know, the thing is if I want to sell like a 3-day option, especially if like sometimes you will want a little bit more wiggle room. Like sometimes I will sell like the 210, like maybe I want to try and scoop it up at the bottom of the range, sell the 210 puts. So if I do that, like if I sell like a 2-day option or something like that, I might only be able to sell the puts at 15 cents or a dime or something, where you're just not taking in enough premium. So there's always this balance. You want to sell as little time as possible, but you get more premium the more time you sell as possible. I want to sell, a lot of times I want to sell farther away from the money if I'm not as aggressive to buying it, or if I want to buy on a lower dip, or I just want to skate if it's naked. But the closer to the strike I sell, the more premium I get. So like that's kind of the thing that makes selling puts interesting. It's very much a science, but it's also very much an art. What is your process for identifying low IV candidates with decent premiums? Well, you know, look, there's some tools out there, and you can Google them. If you're newer to options, and if you're just doing something like selling puts and not getting super fancy, I mean, the one thing, you know, is when stocks go down, implied volatility tends to go up. If you want to look at something general, you can look at the VIX. Just type VIX into your Firstrade platform. Look at a chart of it. If VIX is higher, there's a pretty good chance that options all across the board in Apple, in whatever, are also higher. So like if you don't have, you know, a good resource right now for volatility charts or stuff, just look at the VIX. It's not perfect, but it's good. Or you just look at it and say, yeah, I mean, the more I trade things, like the more I sell puts or calls on specific stocks, I kind of get to know, hey, you know what? Usually if I sell a 1-week option on Apple, I can get about 0.8% if I sell, you know, a certain amount away from the money. Hey, this week I can get 1%. Oh, options are more expensive. Oh, this week I can only get 5%. I might skip it this week. So there's a lot of workarounds if you don't have like some sort of service where you can analyze volatility. Can you share what are the stocks you sell puts with low volatility that generates consistent income? Boy, geez, you're just asking for everything over here, aren't you? You want me to like, you know, tell you where Jimmy Hoffa's buried too? Geez, Louise over here. I'm just kidding. You know, one honestly is Apple. That's one that I do what I call the wheel strategy, covered calls and cash secured puts. Another one is Amazon. Another one is SPY. Royal Caribbean, that one I give myself more wiggle room because it tends to have bigger swings. That's a little more challenging, but a little more fun too. What other ones? Yeah, well, that's a few to consider. Chris, what's up, Chris? What do you think about selling puts on MELI? Oh, geez, MELI. Oh gosh, I know I've traded that before. What is that again? I don't have my platform open, so I'm not really able to analyze it live real time. If you refresh my memory on what that stock does, maybe it'll jar my memory, but the ones that are really super crazy volatile are not great candidates. If they're kind of volatile, like Royal Caribbean, where you do get kind of good swings, but it stays, Mercado Libre, yeah, where it stays kind of in a range, maybe uptrending range or downtrending range. I like those, but if it's just crazy all over the place, it starts to not make sense because it can just blow through your strike. Or if it goes the other way in your air quotes favor, your profit's just so limited. So, just avoid the really, really super volatile ones. That's about the best. Oh yeah, that's right. Yeah, thanks, Aslam. Yeah. I forgot about that. Haven't thought about that stock in a while. Holy cow. Yeah, I haven't obviously I haven't looked at a chart in there, but if it's super volatile, I would say no. But if it's just a little bit volatile, you can sometimes get some pretty juicy premiums. I'm a beginner in this. How should I start? Asks Janice. Yeah. So start out slowly. What I like to do is, and remember, the cash secured put is an investor-oriented strategy. So that requires a little bit more capital because you want to get assigned. You want to take that cash and buy a stock with it and use the put to help you do that. So I would look for a stock that you want to buy and hold in the long run, that you have enough capital to buy, like Apple at $215, 100 shares is $21,500, and we've got to do them in 100 share lots. That's what each put represents. So I would look for a stock that you want to buy. Could be something like, Philip Morris, for example, MO. That's a fairly solid stock here. If you're a big anti-smoker, don't get mad at me. I just look at things from a pure financial standpoint. So that's pretty solid stock. It's trading about $51 a share right now. It cost you $5,000. If you like that stock, and I'm not trying to talk you into it, I'm just giving an example of a stock that I personally like, maybe consider selling just one at the money put or slightly out of the money put and expect to get assigned. And if you don't, you've got one under your belt, as they say. Sell another one. And if you do get assigned, then you own the stock. I think it pays dividends. I forget. Buy and hold, because that was your objective. If you like that stock, you like it for the buy and hold strategy, buy it and hold it. Or at some point, once we get to the wheel strategy, we will talk about how to roll into selling a covered call against it. Good questions. Melly has a big bid ask spread and low open interest. So the fill is bad and difficult to open and close. So that brings me, and this is going to be my last question. We're at the end of the hour here. Okay. So with stocks that have very wide bid ask spreads, like Apple, in this screenshot, this is a little bit wide. It's not really that wide. My rule is I don't want the offer to be any more than 10% higher than the bid. The bid here is 270. So I wouldn't want the offer to be more than 27 cents above 270, so 297, and it's not. And I think I took this screenshot after the close, so the markets tend to be wider after the close. So like this is fine. But when the bid-ask spreads are very, very wide, I don't want to do that with a naked put because I'm more likely to trade out of that. And, you know, maybe take off half now, half later. There's more likely to be more trading. If I really definitely want to get assigned and look at this as a way to buy the stock at a lower price than it is now, I don't care as much about how wide the bid-ask spreads are because I'm just going to let it expire. I've only got to deal with the bid-ask spread getting in, not getting out. So if I can sell it, you know, I don't like to sell the bid. I like to middle the market a lot of times. If I can sell it somewhere between the bid, or yeah, between the bid and the middle, getting into it, I'll trade ones with wide markets, you know, if I'm trying to get assigned. Do I ever recommend selling puts on ETFs? Absolutely. That's the most common one I do. I do it on spiders. Okay, last question. When a stock gets uplisted to the NASDAQ, does it automatically get options listed on it? No, not necessarily. It probably will, but not necessarily. Whew. Okay, you folks were a great audience. This was awesome. You asked some great questions. When you ask good questions, it shows that you're smart, that you're paying attention, that you have a thirst for knowledge. And speaking of that thirst for knowledge, we have next week's webinar is kind of a follow-up to this one. It's selling credit spreads to generate income. And I hope that you will join me, and I hope that you will tell all your friends about it and that they come and join me too. And that said, trade smart, and I'll see you in a week.